Hi. Let's learn about coverage ratios. A coverage ratio is a metric to measure a company's ability to service its debt and meet its financial obligations. It helps determine how easily a company can make interest payments on its debt or pay dividends. Analysts and investors study the trend of coverage ratios over time to understand the change in a company's financial position. Coverage ratios come in several forms and can help identify companies in potentially troubled financial situations. It's important to understand that low ratios aren't always a sign of financial difficulty. Factors such as net income, interest expense, debt outstanding, and total assets should be examined to determine the health of a business. Liquidity and solvency ratios should also be considered to ascertain whether the company is still a going concern. The interest coverage ratio measures a company's ability to pay the interest expense on its debt. An interest coverage ratio of 2 or higher is generally considered satisfactory. It is calculated by dividing EBIT by interest expense. The debt service coverage ratio measures how well a company can pay its entire debt service. A debt service coverage ratio of 1 or above indicates that a company generates sufficient earnings to cover its debt obligations. It is calculated as net operating income divided by total debt service. The asset coverage ratio looks at balance sheet assets instead of comparing income to debt levels. It's similar to the debt service coverage ratio and is defined as total assets minus short-term liabilities divided by total debt. It's recommended to have a minimum asset coverage ratio depending on the industry. To illustrate the potential difference between coverage ratios, let's consider a fictional company, Cedar Valley Brewing. The interest coverage ratio for the company is 6.0, while the debt service coverage ratio is 1.05, indicating that the company looks riskier from a debt perspective despite generating a positive cash flow. Here are 3 key takeaways. 1. A coverage ratio measures a company's ability to service its debt and meet its financial obligations. 2. The higher the coverage ratio, the easier it should be to make interest payments on its debt or pay dividends. 3. Common coverage ratios include the interest coverage ratio, debt service coverage ratio, and asset coverage ratio. Hope this would help. Thanks for watching.